Welcome to this week's review. We're going to talk about illiquid investments. I hope everybody's well and healthy and whatnot. So what I want to do is to talk about first the liquidity premium and why people invested in illiquid investments. Then I want to go through some history, talk about what we've done historically, where we are now, and what the offerings look like. So the liquidity premium is something that's a fairly simple allocation. What you do is to determine what you think are the expected returns from liquid assets over the next decade, and then determine how much more would you expect to get from an illiquid investment. And if you can get your investment returns met with liquid investments, you wouldn't really need illiquid investments. And so if you go to Research Affiliates website today, what you'll see is that 10 years from now, the expected return of the Barclays Aggregate Bond Index is negative 1.2%, that the expected return of the next decade of the S&P 500 is 50 basis points, and they do it in a dynamic way, so the 60-40 portfolio is negative 0.10 basis points with a level of volatility of 6%. So the liquidity premium is really a return that is demanded by investors because they cannot convert their illiquid investments in a quick way. And so the question is, if in the S&P 500 you're going to get 0.5% over the next decade, so it'll be a decade very similar to the zeros, what would you accept? Would you accept a 5% annualized return, or 7%, or 10%? If you go back a decade and you ask yourself the same question, when Research Affiliates was suggesting that the expected return over the decade we've just lived through was over 10%, then what would you expect? 15% or 17% or 20%? So the history of private investments was really started in 1946 by a company called American Research and Development Company. They became famous in 1957 for making a $70,000 investment in digital equipment company that became worth in 1968 at the IPO $355 million. That's an annualized return of 117% over 11 years. My expectation is that would meet everyone's expectation on this call or on any call for what the returns are. And what happened after that in the 50s and 60s and 70s was that it was illiquid investments were a very small part of the whole landscape. In the 80s, that seemed to take off, and some funds, pension funds, did accept that they would have, as part of their investment, illiquid investments. The Silicon Valley really blew up in the 90s. It was by invitation only. There were some great successes, you know, Amazon, Google, Netflix, etc. There were also some remarkable busts. I mean, all of the dot-coms and the way they were priced was completely insane. While the private investors may have made, you know, Pets.com, while it was a private company, may have had a good return. They became nothing. So and again, as you look back to the 60s and 70s, most of the businesses were really mundane businesses that just happened to be private, and some preferred not to be public because they didn't like the scrutiny and the regulatory issues that were brought on them. And you can even go back to, Elon Musk's quote, I think it was earlier this year, where he threatened, maybe it was last year, he threatened to take his company private and even named the price. The SEC censured him for that. But the 2010s has really changed a lot of things about private investments. So it has simply given us lots of examples of companies that were private that became worth a lot of money, and has increased the interest. But that cycle existed actually, if you go way back in the 60s and the 70s, and the cycle would be this. After a recession, a private equity fund would start a small fund, and they'd get a high return. And then they'd have good performance, and after good performance, they'd have a big fund, and they'd have low returns. Because while it's true that private equity can get very, very attractive returns, the variables are mixed, and the variables about the business and how good the management is and all of that have been are just wider than they are with public companies and the reporting that public companies need to do. So we have avoided funds with one exception, and we have been shown all types of funds that reportedly had great ideas and experts and access to companies and all that. We did two funds actually by the same company. It was a company called American Infrastructure, MLP. And there were two things that attracted us to it. So this was well over a decade ago, the first fund was. They were going to buy companies that weren't MLPs, but could be and make them MLPs, and they were going to distribute 10% cash flow from day one. So those turned out to be great ideas. But it was because of the cash flow. And honestly, their idea was so mundane that we went through this with the guy who started it because we were interested because of the cash flow early and the fact that there were all kinds of companies that could be MLPs and weren't, but the expected returns weren't high, and why would you be returning cash flow, I think was the mindset of those people looking for private equity. We have been approached with high expected return funds after 2008. I can't tell you how many real estate developers came to us and told us they were going to start a fund because they had the unique ability from some banks to be buying real estate out from the banks at bargain prices. And we thought that was going to happen. It's why we spent so much time with these people. We thought actually you were going to be able to do that. But we never hired anyone because honestly, we could never figure out who was actually going to get these and were the banks actually going to do that. So today we have two types of private investments. One are mundane, high cash flow businesses similar to American Infrastructure, but with short, what we refer to as short duration. That is to say, they're not long-term funds. American Infrastructure was a 10-year fund. We don't like 10-year funds. And so we have 5 criteria that we look for when we're looking at mundane high cash flow business. The first is it has to be a mundane idea. It has to be something that technology can't do away with or whatnot. The cash flow has to be high, so that's a relative thing for us. It can be a business or a fund. It has to have a maturity in a reasonably short period of time. 5 years would be the upper end of that. And the 5th criteria we have is there has to be no K1s. And so that's the first criteria. That's the first group, is just high cash flow, mundane businesses that our clients are going to get cash flow monthly and have a reasonable expectation of a return beyond the cash flow. The second type of investment that we're making is really a barbell, and it is without, I don't like using sports analogies, but I don't know a better one. It's a home run striker. It's an investment in a company that is private, that for some reason is doing something that is going to change the world. So I just want to go through one investment that we have in the mundane area and show you the specifics, because it will be representative of everything else we ever get. The name of the company is Landmark. Some of you have clients in Landmark. It's actually an investment company from the first American Infrastructure MLP company. We had actually met them before they were bought by American Infrastructure. Maybe it was the second MLP fund, I don't remember. But at any rate, so we have done about 10 of these funds with them. What they do is to buy leases on cell towers and billboards near airports in major metropolitan cities. The structure is really what we like. It's the fairest structure we've ever seen. Landmark charges 30 basis points. Their business is actually interesting because what they need to do is to hire 100 people to call companies that are leasing the cell tower or the billboard. These are typically 7-Elevens or gas stations. And so they have a little 30 by 30 piece in the corner where this tower goes up, and they get a regular check by it. And so what Landmark figured out was we could go offer them similar cash flow to what they're getting, but diversified, and so that's what they do. The structure is this. And in each of these funds, there'll be 300, 400, 500 of these leases. So they're well diversified. And if there is a failure in a fund, it's just small, so it's not going to impact. The structure is Landmark charges 30 basis points to manage this portfolio. The individual investors get 6% cash flow from the first month. If you put your money in today, literally in August, you'll get a cash flow. These have, from the first close, there's always more than one close, because what Landmark does is to hire these people to call the people who have the owners of the 7-Eleven and gas stations, say, do you want to sell your lease? And so once they compile enough leases, they have a closing in the fund. That each fund closes 3 years from the first close. So the most it can be is 3 years. Now there is written into these contracts the extension at the discretion of the general partner of 2 one-year extensions, and at the end of 5 years, it has to be liquidated. We were happy at the end of 2008 that these were being extended because obviously you didn't want to be selling something at the end of 2008. The structure is such that when it is sold, the limited partners get all their money back. They've gotten a 6% cash flow. They get an additional amount So the IRR is 8%. After 8%, until the limited partners get 10%, they get 65% of the cash flow, and the general gets 35. It then flips. The general gets 65 for the rest of it. We've had about 10 of these funds. The individual returns in each fund have ranged from 12% to 15%. The clause that has changed in this fund, Fund M, that would have us put expected returns on the low side of that, 11, 12%, is that it used to be that the investors got 35%, 65% of everything. And so after 10%, you're only going to get 35%. Fund M will close in August, and the investment will then be 2 years from August. So what your clients are going to get is 6% cash flow for 2 years, and assuming it can be liquidated at that point in time, and an IRR of about 11%. Some funds have closed sooner than the expected maturity date. We don't like that, frankly, although there's always another fund, a few months later. So that is an example of, and there is a K1. It is a federal K1. It says dividends. You do not need to file 5 or 6 or 10 state tax file returns in 5 or 6 or 10 states, even though there's 5 or 6 or 10 states in the fund. They take care of that, and that would be a requirement of anything we would do. We have looked at lots of other things to build a pipeline. We have, one of the things we love that we think can have similar infrastructure is storage. And we think we, at least in theory, can come up with the storage funds. There's 2 fund companies that we'd like, that we have had discussions about in their next fund, finding a place for us with these infrastructures. And so, anyway, that's the mundane part. If you think about returns from all of our liquid strategies today, so equities, you've all seen the piece that we've written on cash flow from the dividend strategies over the next decade will be 5 3/4, and the final dividend yield 10 years out should be 6 2/3, assuming half the dividend growth rate that we've seen over the last 20 years. So that's kind of 10% rates of return. This is, in our view, another source of, it's clearly equity, and it's another source of similar type returns, 11, 12% returns. So that's how we would have an expectation about using Landmark. It's a $50,000 minimum. It's stated in all materials, it's $100,000, and the exception for our clients, $50,000 minimum. And so that's the mundane idea. The home run strikeout idea is this. We have 2 sources to get access to private companies. Let me tell you what we've rejected first. We've rejected funds that invest in a lot of private companies. The example I used before about, after a recession, company will come out with a small fund, have great returns on that, come out with a big fund and have low returns. The reality is we think we can make a judgment about individual companies, and your clients can make judgments. So I think if you're going to do this at all, and I don't think this is very much money, and it's not for many of your clients, but if you're going to do it, and you're going to have, just as an example, 10% allocation to this. You don't want, you want to do this in 5 to 10 different investments. You don't want to say, I'm going to put a 5% or a 10% allocation into this. So we have 2 sources of this. There are 3 companies that will be available. One is available right now, and the other 2 will be available to us later in the year. The first company is a company called Cibus. In the interest of full disclosure, I have invested in Cibus. It's a gene editing company. It's CIBUS. You can read about it on the website. It is revolutionizing how plants can change to adapt to better environments. And it's doing it in a non-GMO way. And the companies that have controlled this market are all GMO companies, and we think this will replace it. The second, so that's available right now. The second company that will be available, you'll be familiar with, it's Elon Musk SpaceX. That'll be available later in the year. And the third is the Amazon of South Korea. So all of those are high risk investments. There's no doubt you could lose every dime in them. And it would be a strikeout. It's also the possibility for very, very high returns. So the last thing I want to talk to before I get to questions has to do with a company called ClearList. And honestly, you should know this exists, but we're a little bit on the fence on it. If it works, it's a brilliant idea. And there's been attempts at this. ClearList's stated goal is to be the equity marketplace for private companies. So they will bring buyers and sellers together of private companies and make a market. The first company they have selected is Cibus. And when you talk to the folks at ClearList, and I've talked to the chief financial officer at Cibus about this, they think this is a way to determine how to get to an IPO. As many of you have observed, I'm sure, IPOs come out, Lyft, for instance, came out last summer and immediately fell to about half of what the IPO price was. So the company did really well, but the investors did terrible. And it's come back, but that's not uncommon. And then the other thing that happens is that there was a company called DraftKings that came out earlier this year, and it came out in round numbers at $12, and it's 40 or 38 or something like that. So that didn't work out as well for the company, but it worked out really well for the investors. That's the problem with private companies, and so ClearList is attempting to get some equilibrium before you get to IPO. Paul Tudor Jones, I just want to read this to you, has said ClearList has invented the future of private equity investing and should set an industry standard by creating an unparalleled technology solution that solves long-standing problems, while also is giving access to private equity qualified purchasers and accredited investors. So I think that's right if it works. And it also could stabilize the process of getting to when does a company go public. I think there's a good reason for us to think about private investments. There's a good reason for the high cash flow pieces like Landmark to be some piece of your clients' overall allocations, and for a small percentage of your clients, the private equity home run strikeout stocks are also something that you should think about. I will tell you that we've had experiences where clients use the CBIS idea, for instance, not necessarily CBIS, but something like it. You know, if a client was going to put 1% or 2% in that, that's what got them the other 98 or 99%. So anyway, that's that. I hope that helps in understanding what we're doing on the private side. We have written about this, and we can send you the piece if you'd like to see it. It came in all of the things that we sent to you, in all the things that we did. So, questions. Do you have any specific questions? You know, I think particularly this home run strikeout thing is you know, a beauty in the eye of the beholder for your individual clients. So you know, we really need to talk about those individually. So okay, you can hit your little thing, and I can allow you to talk. And you guys are frustrating me again because it doesn't look like anybody's got any questions. Either explained that perfectly, or you have all discounted it. But it looks like there aren't any questions. So with that, I'll close. We will have a session next week on dividends from a slightly different angle, because you know, I just think I think it's a little bit misunderstood. So I just did get a question, a little different topic, from Craig Mickelson on ARC, which is one of the disruptive technology managers that we're going to use. And he's asking for an update on ARC. We have a contract back from ARC. We got a note from them yesterday saying they are sending us the portfolios. Actually, we got a note on Monday saying they were working on the 10 stock portfolio and sending it to us. We haven't seen it yet. I expect it in the next few days, and I expect us by the end of the week to have a write-up on ARC and all the materials on the portfolio, and how you can use that in your own portfolios. I will tell you that ARC is volatile. I know we've talked about that, but you got to remember that Tesla is one of their positions. You could buy Tesla a year ago at 200. I think it's 1,600. It was 1,800. So we're going to have volatility in that portfolio. And while I think it's a great idea, and I think this is just a remarkable company, you know, there are 10 analysts. Kathy Wood is the portfolio manager. They have a head of research, and they're all focusing on the same thing. I think it's a great idea, but I think you have to be careful about whose portfolios we put this in. So with that, it looks like there's no further questions. I will close. I hope all of you, wait a minute. Oh, it was just a note from Craig. Thank you, Craig, saying thank you for the update. So with that, I will close. I hope everybody continues to be well, that you enjoy the summer, and I look forward to talking to you next week. Thanks for